Can your wages be garnished for defaulting on student loans? Imagine waking up one morning and finding part of your paycheck missing before it even hits your bank account. That's what wage garnishment can do if you default on federal student loans. It's a serious step the government can take to get back the money you owe. But how does it work? And can your wages really be taken from you? Let's break it down. When you miss payments on your federal student loans for more than 270 days, which is about 9 months in a row, your loan is considered in default. Once that happens, the government can start wage garnishment without going to court. This process is called administrative wage garnishment. It's a way for the government to collect what's owed without needing a judge's approval. The government can garnish up to 15% of your disposable pay. Disposable pay is what you earn after taxes and Social Security are taken out. So if you make $2,000 a month, up to $300 could be taken from your paycheck. This garnishment continues until your loan is paid off or you take steps to get out of default. Recently, collection efforts on defaulted federal student loans restarted after a pause that lasted for a few years. Notices are now being sent to borrowers whose loans are in default, warning them that wage garnishment might begin soon. If you don't act, your wages could be garnished, and that can make it harder to pay bills or save money. Before the government can garnish your wages, they must send you a notice at least 30 days in advance. This notice will tell you how much you owe and explain your right to request a hearing. You have about 15 days from receiving that notice to ask for a hearing where you can challenge the garnishment or explain your financial hardship. It's good to know that your employer cannot fire you just because your wages are being garnished for student loans. This legal protection means your job is safe, even if part of your paycheck is being taken to pay back your loans. Now, how do private student loans compare? Private lenders can't automatically garnish wages. They need to sue you in court, win a case, and get a court order before they can take money from your paycheck. The process varies by state, and it's generally more complicated than with federal loans. If you're facing wage garnishment, there are ways to stop or prevent it. One effective method is loan rehabilitation. You make 9 qualifying payments within 10 months, and your default status is removed. These payments are often about 15% of your discretionary income, but you can ask for a lower payment if needed. After 5 of these payments, the garnishment must stop. You can also request a hearing to challenge the garnishment if you believe it's unfair or if you're facing serious financial hardship. Showing proof of unemployment or urgent bills like rent or utilities can sometimes persuade the government to pause or stop garnishment. Paying the full amount owed is another option, though it's not always easy. Consolidating your defaulted loans into a new loan can help, especially if you agree to an income-driven repayment plan. Just keep in mind that consolidation might increase your overall interest costs. Remember, federal student loan debt does not have a time limit for collection. The government can pursue collection actions even years after you default. Besides wage garnishment, they can also take your tax refunds or garnish up to 15% of your Social Security benefits through the Treasury Offset Program. If wages are garnished, you won't get a refund of what's already taken, but wages garnished during rehabilitation count toward your payments. Being aware of these facts can help you act quickly if you're in default. Reaching out to your loan servicer or collection agency to discuss options can make a big difference. Taking steps early can help protect your income and put you back on track with your student loans.